Pleasure to be here with y'all. Something really important happened earlier this month. For the first time ever, World War II is closer to the Civil War than it is to the present. With a longer-term view of history, I think it's really instructive at this moment, where geopolitics seems so uncertain. And I'm reminded of how historians today of European history look at World War I and World War II as two parts of the same conflict, with a 20-year armistice to answer what's called the German question. How do you resolve Germany's propensity for economic, political, and military hegemony over Europe? When I was working on one of my books, I wasn't sure how to start it. And it was about geopolitics, the current era we're in. Happened to be in California, Southern California. A friend of mine happened to be there as well. And at the time, he was a professor at National Intelligence University, the shorthand of which is grad school for spies. And we had some time to kill. He said, let's go to the Nixon Library. Have you ever been to the Nixon Presidential Library? I said, no. So let's go. Like a Nixon fan, but I'm like, well, let's go. Let's see the thing. And everywhere you see, everything you see there, every statue, every picture, painting, postcard, is this. Nixon shaking hands with the Chinese Premier Zhou Enlai on the tarmac in Beijing in February of 1972. This is the moment that drives a wedge between China and Russia. It's the beginning of the end of the Cold War. But there's a price. And if you look closely enough at this picture, you can almost see President Nixon palming over a check to Zhou Enlai, which says, pay to the People's Republic of China in the amount of 1 Taiwan and 00 over 100 cents. For the young people, a check is what you pay people with a piece of paper. But it's a post-dated check, and that one China policy that the US and Japan and everybody else agrees on is strategic ambiguity. It's an agreement that Taiwan's not its own country, but, well, it's not exactly China, but we'll decide this later. When I think about the Cold War being born in the 70s, I think a lot about Russia, because that's what I heard mostly about. But looking back now, I wonder if we got the Cold War wrong. Where does the Cold War go hot? Yeah, there was the Berlin Wall, and the Prague Spring, and the Luftbrücke, and everything else. But the Cold War goes hot in Korea, in Vietnam, in Southeast Asia. It goes hot in China's periphery. 50 years to the month of this handshake. At the Beijing Olympics, Russia and China get married. On February 4th, 2022, they issue a joint statement. And the statement says, again, it's 2022, China and Russia strongly uphold the outcomes of the Second World War. This is 2022 now. And there's no limit to their cooperation. Quick refresh. The way the world looked at the end of World War II was China bigger, Russia bigger. And within just a few weeks, Russia invaded Ukraine. This makes me wonder if maybe historians 50 or 100 years from now will look back at where we are and they'll go, Cold War I and Cold War II are two parts of the same conflict with a 50-year armistice to answer the China question. How do you resolve China's propensity towards economic, political, and military hegemony over Asia? This is the big challenge of this century. And it's perhaps perhaps the only major bipartisan issue out there. Based on recent Pew Research, 77% of Americans have an unfavorable view of China. You go back to 2005, it was only 35%. That's why, although we hear a lot about domestic political squabbles, disagreements, and outright antipathy, this topic seems really quiet, and the silence is deafening. The truth is, our next president could be J.D. Vance, AOC, or the Hamburglar. It doesn't matter. They won't want to live on planet China either. Let's talk about World War II. A lot of what we've seen, not just in this administration, but in past administrations, ties into something that national security professionals refer to as the DIME framework of national power. It has 4 elements: diplomacy, information, military, and economic. We're all familiar with the military attributes of national power, something you want to have but not need, and something you don't want to need and not have. Diplomacy, very clear. Information, today's environment, misinformation, disinformation, this becomes more important than ever. And then there's economic, perhaps the biggest, most underutilized lever we have. And it's my opinion that not just this administration, but we've seen this previously in the Biden administration and the first Trump administration, we've seen that become the big push. Let me tell you a story. In the fall, I'm one of the 100 CEOs on what's called the Texas Business Leadership Council. Y'all know what the Business Roundtable is, 100 CEOs, the biggest companies in the country. They advise politicians of both parties on nonpartisan issues. There are 27 states that have similar groups. 100 CEOs, I'm one of those 100 CEOs, have been for a dozen years in Texas. I'm also the chairman of a Federal Issues Task Force. This means every year we go to DC, we meet with our congressmen in both parties, one or both of our senators who happen to be Republicans, and the administration, whichever administration happens to be, because we're meeting there on nonpartisan topics. In the fall of 2024, we went up at a meeting at the White House, and one of the heads of the National Economic Council comes to meet with us. She sits down, she's right across from me, and the first thing she says is, the U.S. industrial base is the strongest since the Vietnam War. She doesn't say since 1971 or 1969, she says since the Vietnam War. Insert name a really big conflict here. About 6 months later, we have a Department of War, a Secretary of War. This is moving forward. This crosses party lines. If we think about how that economic power plays out, and I'll talk more about it in the economic outlook and what it means for markets, there's 2 pieces. One is really strong. Our GDP, the biggest in the world, our capital stock, all the stuff, all the hotels like this, and businesses and roads, oil and gas assets and airports. Homes as well. And then there's wealth, right? Plurality of the world's equity market wealth is held in the United States. And there's that almost $8 trillion sitting in money market funds. And then there's the labor market, right? Yes, payrolls have slowed, but they've expanded in 20 of the past 24 months. And our unemployment rate is still relatively low, which I'll talk about in a second. And then there's access to debt markets, which, given the fact that there's almost $8 trillion, happy to get 3.25% to 3.5% in money markets, I assume if treasuries went up, the little kid soccer team would rush into that. But there's something weaker, and that's the self-sufficiency piece. This is what part of the big push around tariffs has been around. And I know right now this is a chaotic time for that, but the logic behind it is to bolster U.S. self-sufficiency. Materiel production, weapons production, dual-use technologies, right? Stuff that can be used for civilian and military purposes. Think computers or aircraft parts. Raw materials, right? This is what a big deal was with Ukraine. We just did a big deal with Australia on this. And there's a discussion around this with Greenland, right? Rare earth minerals, right? And then there's tonnage. If you're building weapons, you need to be able to make enough steel and aluminum and copper. I don't think it's a coincidence that for the first time since World War II, we're no longer making copper pennies. And then there's medical. During the government shutdown last fall, despite how much Democrats and Republicans were at each other, a bill moved forward, passed through the Senate. What was it for? Restricting investment in biomedical technologies in China. This is a bipartisan thing moving forward. All of this, and part of the goal, honestly, of the tariffs, if you look through some of the executive orders, a big thing that hasn't caught a lot of attention, which is going to be a big sticking point in the USMCA review in the mid-year, is transshipments. This is where you take something, right? Take it out of China, it arrives in Mexico in a made-in-China box. You take it out of the made-in-China box, you put it in the Hecho in Mexico box, and you send it north across the border to evade tariffs. You can also do the same thing in Canada, but the box has a beautiful red maple leaf on the side, and you send it south. Either way, you're evading tariffs. The now struck down July executive order around tariffs had a third section of that. The first section was, we're doing tariffs to strengthen the U.S. economy. Section 2, here's the new rates. Section 3 was, if we find that goods are being circumvented being moved around in order to circumvent tariffs, there will be a 40% ad valorem tariff, plus fines, fees, etc. And the Customs and Border Protection U.S. Chair will be monitoring those supply chains moving forward. So, a lot of this is about an economic fortress in North America. No one wants Cold War II. Make no mistake, China's a great place. We got a lot of money for a long time. That time's over. A lot of folks are, and we have a beta test for this, right? Look what happened with Russia. If you own stuff in January of 2022 in Russia, you own stuff. And a couple months later, you didn't. Now, that's not as big a deal with Russia because, yes, topographically, the biggest country in the world, but economically, the size of Italy or Florida, but without the gators, but with nuclear weapons. China, though, is the second biggest economy in the world. What happens if all the stuff everybody owns in China becomes a distressed asset goose egg on a balance sheet? Why do you think China's stockpiling gold? They want to cash the check. No one wants Cold War II. But what everyone really doesn't want is World War III. Folks I work with at SOCOM, at the Joint Special Operations University, love to say, effective deterrence requires credible threats. This is why you look at the One Big Beautiful Bill. You look last February, the president was talking about shipbuilding in his joint session of Congress. Why? Well, we have arguably the most powerful Navy in the world and the biggest tonnage. But by number of ships, China has a bigger Navy. And it's all in one spot. So this is about economic mobilization. This is going to drive some of the biggest economic and financial opportunities of the next decade. And by the way, I know I see you all taking pictures of the slides, the data economic paparazzi. I just want you to know that everybody's going to get a sanitized copy of the deck, so you don't have to worry about that. That means you can focus on taking pictures of me. The other thing about economic mobilization that's really important is, and this is basic economics, if you want to improve your exports, you want to boost domestic manufacturing, you want a weaker currency. What do you say if you're preparing for a wartime-ready economy to weaken your currency? You say whatever it takes. And I get it, there's a discussion, the dollar's dead, and oh man, the dollar's gone down a lot. But that's the daily chart. If we look at the weekly chart, well, yeah, it's down, and if we look at the monthly chart, it's actually stronger than the average of what the dollar's been in the last 25 to 30 years. One of the big things that happened here is forward guidance was pulled in the executive branch of government. I remember being at a small dinner. The Atlanta Fed does an annual financial market conference meeting every year. It's a small thing, it's quite big now. But initially, there were only a couple dozen people to go. And I remember being at a dinner with Ben Bernanke, and he was talking about the three big levers that the Fed has. You know, there's the federal funds rate. We're all very familiar with that. There's the interest and excess reserves, perhaps a little more esoteric, but again, it's an interest rate that moves around, makes people push their capital flows. Then there's the third thing, which is forward guidance. Forward guidance is when the Fed releases their projections, or they give a speech, and they say, well, we think we're going to cut rates a whole bunch. What happens? Markets move, dollar falls, bond yields fall, equities go up, right? In the end, if all that happens and growth goes up, will the Fed have to cut rates at that point in the future? Maybe not. In other words, just talking about stuff can make things move. This has typically only been kind of the purview of the Fed chair and the Fed members. But last year, it was pulled into the executive branch, right? Because there's going to be a new Fed chair. So the president says, well, the next Fed chair is going to get rates to zero. Dollar goes down, bond yields go down. Cui bono, the U.S. economy bono, right? The economic mobilization moves along. But Kevin Warsh is not the kind of guy to push rates to zero. Plus, there's 12 people, not without reason, and there's 12 people on the Fed, and they all get a vote. In the latest Fed decision, there were 2 people who were more dovish than the rest. They wanted rates to be 0.25% lower, just a quarter point lower than it was. That's the difference we're talking about right now. It's actually not a big one. But talking about a weaker dollar, talking about cutting rates, talking about these things can move the markets in a way that advantages the U.S. economy, boosts our exports, reduces imports, puts the U.S. in a more advantaged position to project more effective, credible threats, to yield more effective conflict deterrence. Nobody wants World War III. So let's start with the global outlook. Latest IMF data is really good. 2024, 2025 global GDP grew at 3.3%. Forecast for this year's 3.3. Next year forecast is 3.2. These are all good numbers. Global population growth, you get 3% roughly GDP. Anything above 3 is gravy. And you can see it here. Everything for the next couple of years for major economies projected to be good. That is great news. In the U.S., things are pretty good as well. You know, we look at the latest GDP report, which was 1.4% GDP growth rate. It's really a little bit slower than it had been, the 4.4% that we saw in the prior quarter. But the interesting thing about the growth rate is, if you looked, the consumption part was actually more than that. It was over 1.5. And if government spending hadn't been reduced in October, the federal government spending peeled 1.15 percentage points off of Q4 GDP. It would have been a lot closer to 2.6. But 1.4 is still an okay number, especially with consumption between 1.5 and 1.6. That's good. And investment also contributed positively. It was really just the government number that was negative. Most important thing about GDP, and of course we see the next read based on the latest available Atlanta Fed data, GDP now shows likely 3.1% for Q1. That would be fine. These are good numbers. In the latest GDP report, as in many recent ones, consumption is over 69% of GDP. Most of the American economy is people with jobs buying stuff. This is the most important thing I could tell you. If you walk away with just that, that's the win. So let's talk about the consumer for a second, because I know we hear a lot about it, and debt delinquencies have gone up. In the last 4 quarters, this is the percent of all consumer debt. By the way, it's about 19 trillion in consumer debt nationally. 4.8% of it's delinquent. Compare that to almost 12% in 2009, 2010. It's still pretty low, but it's higher than it has been. Right now, it's the highest since Q3 of 2017. And the last 4 quarters, they look worrisome. But a couple things. First of all, the average debt delinquency is 5.7% since Q1 2003, this entire time period. The median, though, is 4.7. We're a little above the median. But what really matters is what happened in the last 4 quarters. You know, if you look 5 quarters ago, the percent of student loans that were delinquent was less than 1%. Today, student loan debt delinquencies, reflected by this red line, are 16.4% delinquent. Let me point out a couple other things here. If you look, credit cards, this is the percent delinquent going down. Auto loans in green going down. Housing, up a little bit, but not a lot. Home equity lines down in recent quarters. The only one that's materially up is this. You may wonder why, but the truth is, with so many politicians that have talked about erasing student loan debt, wiping out student loan debt, the truth is, I paid off my student loans back in 2005. But if I still had some, I don't know, maybe I'd let it ride. Sooner or later, maybe a politician will come along who wipes them all away. It's not an improbable scenario. When is it likely? I don't know. But I think that's what people might be betting on. Sooner or later, somebody's going to come along and just make it go away, so why should I bother paying it back? They're going to take my house, they're going to take my car. If I don't have a credit card, I can't buy groceries. But the student loans, they're not going to come and take my diploma. And they might wipe it out someday. I think that's what people might be thinking. Good news, right? If that's the big sticking point with debt delinquencies, I'm not really concerned. Especially because if we look at mortgage origination and the billions of dollars issued per quarter, we go back here to 2003, the stack bar chart, the different colors represent credit quality. On the left, you see lots of different colors. But here on the right, it's mostly just an icy blue 760 plus mountain of FICOs that are considered excellent credit. 67% of all mortgage origination, dollars, since Q1 2020 went to people with 760 plus FICOs. Best credit quality ever, with some of the lowest interest rates in history, which is why if we look at foreclosures and bankruptcies, they're still really low. So, 69% plus of GDP is people with jobs buying stuff. Consumer looks pretty all right. How about the jobs? The unemployment rate's gone up. You see it on the right. Yeah, we're at 4.3%. It is higher than it was 2 years ago. What about payrolls, right? Payrolls, you can see here, expanded in 20 of the last 24 months. This is after revisions. The one catch, this big month here, October, this big downdraw, that downdraw was government jobs during the shutdown. Private sector looks fine. It's not great, but it's expanding. It's okay. With the recent rate cuts, it might get better. And I know the unemployment rate's gone up, and the reason the unemployment rate's gone up is, even though we've been creating more jobs, there are more people looking than jobs are being created, right? So if more people enter than the jobs are being created, you end up with a rising unemployment rate. But at 4.3%, this is well below the average of 5.6 since January of 2000. So it's up, but it's still really low, relatively speaking. And payrolls, after the revisions, are at a new record high of 159 million. The labor force, at a record, 172 million. This all looks pretty good. Now, if we think about the labor force, 172 million, who's collecting unemployment is about 1.1% of that. There's only 1.8, 1.9 million people collecting unemployment. It's not a lot of people collecting unemployment, right? And even though there's 1.9 million people collecting unemployment, there's 6.5 million open jobs right now. So 4.6 million more open jobs than there are people collecting unemployment. And if we look, the median number of these has been only 4.7 million since December of 2000. So yeah, there's fewer open jobs now than there was before COVID, just by a little bit. And it's a lot lower than it was in March of 2022 when it was a record 12.2 million. But at 6.5 million, this is a lot of jobs. Look back at before 07 or the 01 recessions. There were only about 4.5 million open jobs before those crises began. A lot of open jobs. And I know you keep hearing that, oh man, recent college grads are in trouble, and it's AI, and I'll talk about AI in a minute. And maybe it's not worth it to go to college. I will tell you, I disagree wholeheartedly with this statement. Yes, the unemployment rate of recent college grads ages 22 to 27 was 5.6 in December. Right in December, the national unemployment rate was 4.4. Recent college grads, 5.6. That's not great. But For people who are 22 to 27 who didn't go to college, it was 7.8%. There's been population level data that the BLS has exhaustively covered for years. The more finished education people get at every level, the probability of being unemployed goes down and your income goes up. So where are all the open jobs? And this is probably the mismatch. There's 1.2, 1.3 million open jobs in healthcare and social assistance. There's 433,000 open jobs in manufacturing. There's almost 300,000 open jobs in construction. More open jobs right now than at any time during the housing boom of the aughts. Transportation, warehousing, utilities, over 300,000. If we look back to 07 or 01, there are only around 100,000 open jobs in these categories. The one thing a lot of these have in common, though, is that these are physically demanding in-person jobs. And look, I get it, the labor market has changed, especially in the wake of COVID. I often heard people say, you know what it is? It's all these young people, they're lazy. They want to be at home, in their snuggies, with their dogs, becoming dogfluencers. And that's what happened, right? Except that's not what happened. If you look, labor force participation rates for ages 16 to 19 have been going up over the last 15 years. In fact, they've gone up since COVID. So if they're participating more, who left? It was older workers. Workers 55 plus. They've never recovered to the pre-COVID percentage participation. And workers over 65, they certainly haven't recovered to pre-COVID participation rates. So I guess they're at home in their snuggies with their dogs, becoming dogfluencers. And this tight labor market is why wages are up a lot. If you look, current hourly wage, $37.17, up $8.74 an hour just since January of 2020. I find this wild because the first job I had paid less than half that, paid $4.25 an hour. It was in the 1900s, but it was the late 1900s. The good news, though, is if you are an economy based on people with jobs buying stuff, there's lots of open jobs. And wages are up 3.7% year on year, which certainly beats inflation at 2.4 for the headline or 2.5 for the core. This is why you're seeing continued ongoing consumption positive in GDP. That's good. Now, I know we've heard some of the inflation's been sticky lately and it's gone up. The truth is, I hear a lot of this. I ask people, what's driving up inflation? What's driving up inflation? What's been keeping it high? What do you think?
Medical costs.
Wow, the first person who's ever got it. It is medical costs. That's one of the big things. If we look, I've often heard it's tariffs, but goods, core goods, are up only 1.1% year on year, where core services are up 2.9%. Medical care up 3.9% year on year. Of course there's medical care costs going up. There's 1.2 to 1.3 million open jobs just in healthcare. That's 2/3 of all the people collecting unemployment in just that one category. Fed expects a rate cut this year, and a rate cut next year based on the December projections. We've been consistently forecasting 2 cuts this year, 1 cut next year, but we'll see how it plays out. As Fed Chair Powell noted in the January Fed meeting, the upside risks to inflation have decreased, and the downside risks to the labor market have also decreased. This means the Fed might be hanging out for a little while. There's a really good reason to keep inflation rates pegged where they are, and this has a lot to do with government debt, right? 38, almost $39 trillion in government debt, and it's going up. That's the bad news. Good news is, if we look deeper into where the debt is, 20% of that is intergovernmental debt. And of the 80% that's held by the public, if we break it down, more than 2/3 is held domestically by the public. Now, at some point, I remember, and I can't take credit for this, I saw a guy give a speech, and I think he might have been from the Keynote Institute. He said, with this much debt, at some point, this was maybe 5, 10 years ago, at At some point, the way you would resolve inflation is a mix, or we would resolve this debt is with a mix of inflation and repression. The inflation piece we get, and that actually doesn't make it go away, but repression could look something like the federal government, in its benevolence, insists that people, in order to maintain ERISA-protected accounts, they have to be buying a certain amount of treasuries. Could happen. Could happen. But most of it's held domestically. I know China's recently engaged in another amount of reducing their exposures here. No surprise there. They used to own a lot more. I remember, you know, $1.5 trillion or so in U.S. treasuries. This was 15 years ago, 20 years ago now. And back then, our government debt was 10, 12 trillion. Well, that was a big percentage. Now, 700 billion among 39 trillion is less significant. So even if we get in a kinetic conflict with China, this isn't where the risk is. The risk is around distressed assets. Right, completely goose-egged balance sheet assets, distressed write-offs, that's the risk. Supply chain disruption, medical, manufacturing, rare earth minerals, all kinds of stuff. That's where the bigger risks are, let alone kinetic conflict in and of itself. And while people focus on the debt, the bigger risk is actually entitlements, which have been putting in the operating budget since 2004. Social Security is forecasted to be insolvent in 2034. But for a number of years, Medicare was predicted, since at least 2018, to be insolvent this year. But Medicare will not be insolvent this year. Why? Because payroll taxes increased. And I've had a pretty good career at forecasting things, so I don't think you need to be a good forecaster to think that, well, maybe sometime in 2031 or 2032, we're probably going to increase payroll taxes so that Social Security isn't insolvent. Make sense? What it also means is that this provides a further incentive for AI, right? Not only is there high labor cost, but now if payroll taxes go up more, at least for now, robots don't pay payroll taxes, right? Part of the problem with entitlements is in its very origins. Anybody have any guesses on who the grandfather of Social Security is? You go to the Social Security Administration website. There's a picture. What's the question? Stiglitz? No. Any other guesses? Who's the grandfather of Social Security? FDR? These are so good. I know y'all are messing with me. From the Social Security Administration website, it is Otto von Bismarck. Not kidding. I've included the link. Why? And maybe you've heard of him, right? He's the blood and iron chancellor, a Prussian monarchist. Not exactly a paragon of democracy, but what happened? What happened here is, in the 1880s in Germany, there was a rising socialist party. And, you know, not being the bunny rabbits and rainbow chancellor, he had an idea that there'd be a loophole. You take the wind out of the sails of the Socialist Party by pushing forward an idea that Social Security, and there's a catch. The catch is you get your benefits at age 70. Any guesses on life expectancy in 1880s Germany? That's pretty close. 40. So a 30-year spread, that's the other way we can fix Social Security. At 110, people get benefits. You know, that's the other way to fix it. So this feeds into a lot of the AI opportunities. And I know, like, going forward, when people are looking at this right now, they're trying to figure out, is it real, is it not, whatever, right? In a recent Pew survey, 21% of people surveyed Americans said they believe that people are making a bigger deal of AI than it is, and 36% said they think they're making a smaller deal of it than it is. I think it's probably both. Around this time last year, February, I happened to be in a Target around Valentine's Day, and we were in the card section. And they had the cards that kids give to each other. You know the ones where you buy like a sheet of cards, you give one to every kid in your class, even the ones you don't like? Like you give them the card, right? And they had dad jokes on them. This one I couldn't figure out for the life of me. What's a unicorn's favorite sweet? Google AI said unicorns primarily eat grass, plants, flowers, and berries, but their diet can vary depending on their habitat. They have a low caloric need, usually only 500 to 1,000 calories a week. So these are Ozempic unicorns. And some unicorns may also eat apples or carrots if they can find them, I guess, as opposed to finding the unicorns. This is the garbage in, garbage out problem. When I was in grad school 25 years ago, I had an econometrics professor. Econometrics is statistical economics. That's some of the underpinning math of these LLMs now. And she would run a model. It would take her 3 days. She would put chairs around her desk, so no one would go near her desk while it ran untouched for 3 days. Good news, today, you can run that model in 3 seconds. Bad news, she used to spend 3 weeks preparing the data before running the model. Today, people spend 0 seconds on that. This is the problem. A good data process, you ask a question, you scope a project, you collect the data, clean the data, analyze it, test it, and retest it. Today, people have a spreadsheet of data, they just want to throw it in the gunkulator and see what happens. So that's a risk. Data is insanely valuable. It will be more valuable in the future than ever, but only if you know what to do with it. And generative AI presents infinite opportunities. Mid-office, back-office functions, it's unbelievable. I know last year I became about 30% more productive with the way that I engage with AI. And I've been using ChatGPT from the beginning, but last year I boosted my output 30%. Unbelievable. All kinds of stuff. Job posting, sales scripts, legal drafts only, please, still use your lawyers. Form letters, press releases, gosh. I used to have this junior analyst, and I love my junior analyst, but he would take a week to write me a press release. It would be trash, And I love my junior analyst, he's my first cousin. And, you know, I would just have to pretend that I liked it, and then I'd have to write it myself. Because I've written so many, I know what a good one is. He found his way, he does tech sales, it's what he was born to do. And ChatGPT was born to write my press releases. And there's a lot of opportunity, right? Like if you look at the share of the working age population using AI, there's infinite opportunity. So just to give you some idea, right? The orange where we're at now is like 21 to 35%. We're in there. Most of the world though is at the 5 to 20%, the kind of purple. Here's the thing, we have 160 million workers in the US. If everybody becomes just 5% more productive, that's like 8 million more workers. If everybody becomes 30% more productive, that's like 50 million more American workers. And that's just here in America. This is what AI is all about. And this is the question of, well, the valuation's too high. I don't know. If we can increase the workforce by 30% output, how much is that worth? Well, that's worth almost a third of GDP. Okay. All right, now we're talking big numbers. And as for the risks, they're out there, right? Right now everybody's all hyped up on AI, but here's the trick. I think sometime soon, sometime very soon, we're going to stop talking about AI. You're not going to hear about it anymore. In the same way today, nobody talks about the internet or that they use computers, right? Anybody here brag to their friends they have an email address? Of course not. It's not 1995, right? And someday, you're going to go into a meeting and either you're going to say it or somebody else is going to say, we use AI. And you're going to go, well, I'm surprised you're saying this because I already assumed you were, right? It becomes foundational, part of the bedrock of the economy, and an invisible operating system of countless industries. And look, this time is never different, right? Economists love to say this, and it's true. In the 1980s, my dad and my grandfather ran a small accounting firm. And that's when Lotus 123 rolled out. Lotus 123, for those of you who don't know, it was the forerunner of Excel, the first digital spreadsheet. Believe it or not, young people don't believe me when I say this, there were people who work in finance and accounting, and they heard there were digital spreadsheets, and they said, no, I am always going to use paper and pencil. those folks were either very quickly out of a job or very quickly out of business. If you're not using AI to support the functions of your business right now, whatever that is, you're saying, I'm not. I'm going to stick with the paper and the pencil. And granted, Excel took over it, and this is what some of the forerunners now of generative AI are worried about. You can be the first to market, but maybe you get eaten alive by somebody else. And I know people might ask, well, yeah, but Jason, isn't this a bubble? What's the opportunity? Is it real? Look, this isn't the dot-com era, right? It's not. Who here has seen, if you haven't seen it, it's amazing, TV interview. Bill Gates on David Letterman. Windows 95's rolled out, and he's trying to talk about why people will have personal computers. And Dave and everybody else in the audience is laughing uproariously at it. And, you know, Bill Gates says, well, you'd be able to watch a baseball game on a computer. And Letterman says, oh, does the television ring a bell? You know, and Bill Gates says, well, you'd be able to send your friend letters, you know, you'd be able to send mail, email. And Letterman goes, whoa, does the post office ring a bell? You know, like, right? Ha, 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 ha. Oh, okay. But it took us a while to get here. And with some technologies, people wonder. And one of the ones, I had a conversation with a very good friend of mine about this last year. And he came to visit me in Austin. And he said, well, how real is this? I'm like, look, it is not crypto. It is not blockchain, okay? I've always been skeptical. He said, you always have. I'm like, yeah. Look, blockchain has plenty of use cases. I think supply chain provenance, very important, especially in a world where we need to know where our dual-use technologies move around. Sure, it's accounting software, good for tracing goods. But as a medium of exchange, it's not great, right? I mean, Visa does 65,000 transactions a second. Bitcoin's at 3. My friend said, well, tell me what you really think. And I said, I think crypto is fake magic internet money. And he says, get out your ChatGPT. That should be your next book. All right. So I get it out. And I said, all right, well, what do you want? He's like, let's make the cover. Okay. What do you want the cover to look like? And he says, I want the cover to be in the style of Romero Brito. It's a certain kind of pop artist, bright colors. I asked ChatGPT to do it, and I paid for the $200 a month version, right? Which, by the way, just a quick thing. It's $200 a month, and it made me 30% more productive last year. What's the future of that? I think the future might be Uber. Who here thought Uber was super cheap and great when it came out? Super cheap, super great. I still think it's super great. Anybody here think it's super cheap? Yeah. So, how much more would I pay for my ChatGPT? I'm not going to say because I know this is being recorded. But it's more than $200. So anyway, ChatGPT said it won't do it. So I asked it, theoretically, what would someone need to ask in order to get something that would, sort of look like this? And it tells me. And my friend says, it doesn't look like a book cover. So I tell her, okay, neaten it up, make it like a book cover. And then, my friend says, never mind, it shouldn't be a book, it should be a song. A song. Who should sing it? Bruno Mars. Bruno Mars should sing it. Okay. So I asked ChatGPT, listen, I want you in the same art style of Romero Brito, I want you to make fake magic internet money with Bruno Mars. That's what I want. Can't do it, I cannot, this violates all kinds of my protocols, right? I'm not allowed to put a likeness of a person, I'm not allowed to recreate an art style. I cannot, absolutely cannot do this. And yet, fake magic internet money by Bruno Mars looks like a real thing. This is pretty funny if you're thinking about images and books and whatnot. It's less funny if you think about people hiding prohibited transactions. Right? If you look at one of the highest value use cases for AI, and talk to folks in accounting, they'll tell you we're trying to get to 100% testing and sampling in our audits. But what happens if someone asks the AI how to hide prohibited transactions so they're not discovered in an audit? And it tells them. And I know folks might say, well, yeah, but the AI we're using, that's the, right. You may tell your people to only use your internal corporate AI. I assure you they're probably also using their preferred AI at the same time. So as for another risk, 50% of Americans surveyed last year said they are concerned that AI will worsen people's ability to connect. And this is why events like this become so important, because in the future we're all going to have this unlimited technology. Analysis, operational efficiency, productivity, infinite. We all have a bullpen full of analysts ready at any time. I've often described it as, you know what it's like? It's like somebody with a master's degree, or rather somebody with 50 master's degrees, but they've never worked a day in their life. So there's risks. What it also means is focusing on relationships, being present, making real connections, making time for people becomes more important than ever. In the future, your network will be your net worth more than ever before. And so as I think about these things, the key economic expectations I have for the year ahead is that we're still going to have positive growth, both at the U.S. and global level. Modestly positive U.S. job gains, modestly easing year-on-year inflation, modestly falling interest rates. As for the biggest opportunities, aside from the potential for interest rates to fall a little bit further, sector opportunities in defense, high-tech, dual-use tech, manufacturing, supply chain, material handling, and heavy industry. Why? We're preparing for a wartime-ready economy. This is where the action is going to be. There's also upside risk for precious metals because of the change in January 2024 from the Bank of International Settlements, the central bank of central banks, that allowed gold to be used for central bank to central bank payments and transfers, treated the same as cash and treasuries, government securities. Industrial metals, well, obviously because if everybody's building more weaponry, right? Japan, they've just passed their biggest military budget since World War II, comparable to their spending in the earlier parts of World War II in the late 30s. Europe, they've also spending a lot more now on weapons too. And all of that's pretty good if you don't want to end up living on the planet China. Looking forward, physically demanding in-person role hiring is likely to remain tight and expensive. So while office productivity, mid-office, back office, going up because of AI, physically demanding in-person roles, healthcare, manufacturing, construction, warehousing, utilities, transport, all of that, probably going to go up more, become more expensive. And you want to think about managing your Cold War II risks. Lastly, because I'm an economist as well as a futurist, I'd be remiss if I didn't remind you to think about these two curves. Do y'all know what the two big factors are that drive markets? You've seen this graph before. What are they? Supply and demand? No, come on, y'all. It's fear and greed. And with that, I leave you the part you're waiting for, my disclaimer. Everything can be wrong. Everything's in classified, my own opinion. And, yeah, that's me. Thank you very much. It's been a pleasure to be here. Come join me next. It's going to be a book signing and whatnot.